Are you tired of the endless, stressful chase to beat the market? What if I told you there's a simpler, more effective way to invest? Today, we are rediving deep into why trying to outsmart the market is often a losing battle and how you can use a powerful, yet simple, strategy to build long-term wealth. Let's start with a concept called the zero-sum game. Think about investing like a giant poker game. All the players are sitting around a table, and the chips represent the total market returns. For every player who wins a big pot, another player has to lose those chips. In investing, before we account for any costs, the combined return of all investors must equal the return of the market itself. This means for every investor who outperforms the market, someone else, by definition, has to underperform it. It's a mathematical certainty. The market average is literally the average performance of everyone involved. You're essentially saying you're smarter or luckier than the majority of other players, including professional fund managers with teams of analysts. It's a tough proposition, and statistically, a very unlikely one over the long run. Before any fees, active investing is a zero-sum game. But here's the kicker, it's not actually a zero-sum game. It's a negative-sum game. Why? Because of costs. The moment you start playing, the house or, in this case, the financial industry starts taking its cut. This is where active management really starts to struggle. First, you have management fees. These are the fees you pay to the fund manager for their expertise and for picking stocks they believe will outperform. These can range from a seemingly small 1% to 2% or even more. While that might not sound like a lot, it compounds over time and takes a huge bite out of your potential returns. Imagine you have $100,000 invested. A 1% fee is $1,000 a year, every single year, regardless of whether the fund actually performs well. Then, there are trading costs. Actively managed funds are constantly buying and selling stocks. Every time they make a trade, there are brokerage commissions and other transaction fees. Plus, frequent trading can lead to what's called spread costs, which is the small difference between the buying and selling price of a stock. These tiny costs add up significantly over a year and are often hidden from plain sight. But they directly reduce your fund's performance. More trading means more costs, which creates another hurdle for the fund manager to overcome just to match the market, let alone beat it. And finally, we have taxes. When a fund manager sells a stock for a profit, it creates a capital gain. These gains are then passed on to you, the investor, and you have to pay taxes on them. Actively managed funds, with their high turnover, tend to generate a lot more of these taxable events compared to a fund that just holds on to its investments. This tax drag can further erode your returns, especially if you're investing in a regular taxable brokerage account. So, when you add up management fees, trading costs, and taxes, the challenge of beating the market becomes almost insurmountable. Think of it like a bell curve. The peak of the curve represents the market's average return. Most investors will cluster around this average. However, the high costs associated with active management effectively shift this entire curve to the left. This means that after accounting for all those fees, the vast majority of active investors are statistically guaranteed to underperform the market average. They start the race several steps behind the starting line. It's not that fund managers aren't smart, it's that they're playing a game with the odds stacked against them. The higher the costs, the further behind they start. So, if trying to beat the market is a losing game for most, what's the alternative? This brings us to the simple, elegant, and incredibly powerful solution: index funds. An index fund is a type of mutual fund or ETF that aims to track the performance of a specific market index, like the S&P 500, which represents the 500 largest companies in the US instead of trying to pick individual winners. An index fund simply buys all the stocks in the index it follows. For example, an S&P 500 index fund will own a little piece of Apple, Microsoft, Amazon, and all the other companies in the index, in proportion to their size in the market. The beauty of this approach lies in its simplicity and, most importantly, its low cost. Since there's no expensive team of analysts trying to pick stocks and no frequent trading, the operating costs are incredibly low. The management fees for many index funds, often called expense ratios, can be as low as 0.03% or even lower. Compare that to the 1 or 2% you might pay for an actively managed fund. This massive cost difference has a profound impact on your long-term returns. By simply accepting the market's return, you are, by default, outperforming the majority of active investors once their high fees are factored in. You're not trying to find the needle in the haystack. You're just buying the whole haystack. Let's look at a concrete example. Imagine you invest $100,000 in an actively managed fund with a 1.5% expense ratio, and it manages to earn an average of 8% per year before fees. After fees, your net return is 6.5%. Now, let us say you invest the same amount in an S&P 500 index fund that also earns 8% per year, but with a tiny 0.05% expense ratio. Your net return is 7.95%. Over 30 years, that small difference becomes enormous. the index fund investment would grow to over $980,000. The actively managed fund would only grow to about $660,000. That's a difference of over $300,000, all lost to high fees. And this scenario assumes the active fund even managed to match the market before fees, which is a generous assumption. The data overwhelmingly shows that over long periods, like 10 or 20 years, upwards of 90% of actively managed funds fail to beat their benchmark index. So, let's wrap this up. We've learned that trying to beat the market is a zero-sum game before costs, and a negative-sum game after costs are factored in. High fees, trading costs, and taxes associated with active management create a massive drag on performance that makes it nearly impossible for most to win in the long run. Index funds offer a simple, powerful alternative. By tracking the market and keeping costs incredibly low, they allow you to capture the market's return and, in doing so, outperform the vast majority of your fellow investors. The message is clear. Stop trying to beat the market. It's a game rigged against you. Instead, let the market work for you. Embrace the power of low-cost index funds and watch your wealth grow steadily and predictably over time. It's the most proven path to successful long-term investing. Thanks for watching, and if you found this video helpful, be sure to hit that like button and subscribe for more content to help you on your financial journey. See you in the next one.